Okay, it's a good evening, students, and welcome to our foundation class for management information. I want everybody who can hear me, who can see my notes and see my calculator, to please go to the chat room and say that they can hear me most especially. That is what I want to know, if you can hear me and as well see my notes. Waiting for your chat to start this class. Once one person can see my notes and can hear me, I am good to go. Can we do that in good time so that we can start? If I don't get response, it means that nobody is hearing me. Okay, now I can see. Okay, all right. So you can hear me, you can see me, you can see my notes. So let's begin. Today, we are going to be talking about short-term decision-making techniques. Now, these short-term decision-making techniques are those techniques that have to do with relevant costs. Okay, so relevant costs can be applied both to short-term and long-term decisions. Now, short-term decisions are those decisions that the financial consequences occur in a very short while after the decision has been taken. That means you take a decision now, the consequence starts coming maybe in a week's time or in a month's time or even 2 months' time, then it's a short-term decision. Now, when I say consequence, I don't mean always a negative consequence. Sometimes a positive consequence can result from a short-term decision. So your short-term decision could either make you or mar you in the short term. Whereas a long-term decision is one where a capital investment is being made. And that means the result or the consequence is noticeable over a longer period of time, usually more than 1 year. So as we see the topic on the board, we're talking about short-term decision making. So it means we're going to be talking about things that will just happen within 1 year. And so we're going to be using something called relevance costs to look at short-term decisions. Okay, the concept for relevant cost is the same for both short-term and long-term decisions. And so let's talk a little bit about relevant cost because that's something important in your syllabus. Okay, examples of management decisions where relevant costing is used are: one, you can see them in one-off contracts. Now, what is a one-off contract decision? A one-off contract is those contracts or those jobs that you don't see every time. It means that you are doing similar line of work, but this particular contract is a little bit departure from what you are doing regularly, but you can do it. And so you take on that contract because you don't see something like this every time. Let's take, for example, you are a carpenter, you are dealing on furniture, you make chairs, tables, cupboards, and somebody comes and meets you and say, please, can you get me a wooden house? A wooden house. I want my house all wooden. Wow. And he knows that a carpenter can do that. That is a one-off contract. So you can be thinking whether you want to undertake this contract for a fixed price or not. And this one-off contract, you are able to undertake it. You have to think if you are going to take up this one-off contract. Then we have other decisions as make or buy decisions. Now, the make or buy decisions, we're going to talk about it in a short while. Then we have a shutdown decision. Now, shutdown decision is either you want to shut down a product that is not doing fine or continue. Then we have the joint product or further processing decisions. Now, this has to do with products that are jointly, like a crude oil is splitting up to petrol, diesel, and kerosene. So you want to either think if you're going to just sell off the crude oil, or you process them further to their various smaller divisions. So these are some of the things that you have to decide in the short term that will affect your business. Now let's take one of these, the make or buy, also called outsource decisions. What is a make or buy decision? Now, it means that you can make something internally, or you may want to buy it externally from an external supplier. Let me give you an example. Let's say you are a bottling company, or you are a drink manufacturing company. Which one am I going to use? Let's say Nigerian breweries. Okay, so you can make, what can I use? Nigerian breweries. Let's say you can make Star, the drink Star, or Heineken. Now, let's use Heineken. You can make this Heineken a liquid, which is your main product. Okay, but this liquid has to be bottled. You can make the bottle, or you can give it to an external person to make the bottles for you. Or let's look at the crown cork, because you have to cork them. You can make this crown cork yourself if you have the machine, or you can give it to an outside person to make the crown cork for you. What about the crates? You can do it yourself, or you can outsource it to an external person to do it for you. Now you have to make that decision whether you are going to take on some of these things internally, or you are going to just outsource them. So that decision is the make or buy decision. Okay. Now, the economic basis for the decision whether to make internally or whether to buy externally, which we call the outsourced production, should be based on relevant costs. Now, what are these relevant costs? Now, these are costs that changes when there is a decision to be made. Now, the preferred option from a financial point of view should be that if we are looking at costs, relevant costs, whatever your decision will be to favor the cost that is lower. Nobody wants to incur high costs. Everybody wants to minimize their costs. And so when you identify the relevant costs that are in play here, you choose the lower. Now, what are the decisions, the relevant costs that are involved here? Now, if you want to make the product yourself internally, that means you're going to be looking at material costs and more especially labor costs for that product. These are called variable cost of production or variable costs to make. You don't put the fixed cost. Fixed costs will never change whether you make them or you buy them. So you take only the variable cost of making the product. Now, this is the decision to make internally. What if the decision is to buy externally? Then there is a variable cost you must consider. That is the purchase price. How is purchase price a variable cost? If you have to purchase something at 5 naira or let's say 10 naira 1 unit, when you buy 2 units, it varies. So it becomes 20 naira. When you buy 10 units, it becomes 100 naira. So it varies proportionately. So that means the make or buy decision has to do with the lower of the cost of making this process or this item, or the cost of outsourcing it outside. Whichever gives you the lower cost, that is what you will take. So you see, if the work is to be done internally, you are going to save costs outsourcing it. And if it is going to be done externally, that means you have to make costs and you have to look for what they call the incremental cost incurred by outsourcing the work. Don't worry, we're going to solve a question and this will make sense. Okay, so now give me a moment before we solve question number 1. All right, now question number 1. It says there, a company manufactures a component, so underline the word a component, that is included in the final product. Now let's try to make this more practical. Let's be imagining this thing. The company manufactures a component. Let's imagine that the company is Nigerian Breweries manufacturing Heineken. Now let's say this component happens to be the crown cork. Okay, so let's read it again. Heineken company or Nigerian Breweries manufactures a crown cork that is included in the final product Heineken, which is also produced. Management have identified an external supplier who will be willing to supply these components. I'm using the crown cork as an example of the component. So management have identified the external supplier who will be willing to supply these components. The variable cost of manufacturing the components internally is 100 naira, and the external supplier would be prepared to supply the components for 130 naira each. It has been estimated that cash savings on general overhead expenditure will be 48,000 naira each year if internal production is ended. Okay, so it means here that if you decide to end producing that component, you are going to save overhead cost of 48,000 naira in a year. The company needs 1,000 units of the component each year. required? Should the company make or buy the components? Let's see how we are going to solve this. The annual relevant costs and benefits of a decision to buy the component externally can be expressed as follows. Now, if you are to buy the component externally as against making it internally. So if you are making it internally, you are spending 100 naira. If you are buying it externally, you are paying 130. What is the extra cost? The incremental cost. Let's say for one, you either make it 100 naira, you buy it start 130. So the extra cost of going to go and buy it outside is 30 naira. Now that's for one unit. Multiplied by the number of units, it means that you are going to go and spend 30,000 naira buying it from outside. But it says that if you have to buy it from outside and you end internal production of it, you are going to save 48,000 naira in a year. So if you look at it, this 30,000 naira in brackets is the money, extra money you are going to spend in buying the product. This 48,000 is the extra savings you will experience when you stop the internal production. And so you see the benefit far outweighs the cost. The benefit of 48,000 far outweighs the cost of 30,000. And so the net benefit is 18,000. Wherever you are getting a net benefit like this, it means do that thing that gives you this net benefit. And what did we do here? We decide to purchase this device or component externally. So the company would increase its profit by purchasing externally instead of making the item in-house. So the recommendation of financial consideration is therefore to buy or to outsource the production instead of making it internally. Okay, so we have seen the make or buy decision, the relevant cost involved in making this decision is to choose which one of them is going to give you a cost benefit that will maximize your cost benefits. Anyone that is going to give you a worse off situation, you don't accept that. For anyone that is going to improve your situation, like we did in example one, your profit will now increase by 18,000 naira. If you are to buy it outside, fine. Now we are looking at this from a financial point of view. Okay, towards the end of this class, we are going to see the non-financial indicators that can also tell you that, wait a minute, you say we are going to buy it externally, right? Have you considered the non-financial factors? Will they be able to meet up our targets? Will they be substandard product? All these are some of the other things that are non-financial in nature that you may need to consider before you make a let's look at make or buy or the labor or this factor of production that is so crucial is in limited supply. And because it is so scarce resources, so you add those scarce resources to things that will not give you higher profits. So you apply it on things that you know are more productive, more profitable, and you apply those scarce resources there. That is what we are looking at in this subtopic, make or buy decisions with scarce resource. Okay. Now, in this type of situation, a relevant cost approach is to assume that the entity will seek to maximize its profits and therefore outsource some of the work provided that the profit will be increased as a consequence. Okay, so the decision about which item to outsource and which item to retain in-house is the management decision to make. But like I said, it's going to be based on two things. One, it's going to be based on relevant cost of making or buying. Then secondly, it's going to be based on the scarce resource. All right, so let's look at example 2 and see how example 2 helps us to understand this topic. A contract cleaning company provides 3 services. Now, these 3 services are daily cleaning office, daily office cleaning rather. Then the second one, intensive cleaning of office space, and 3, minor repairs. Minor repairs. However, it has insufficient resources to do all the work available. Now, underline here, insufficient resources. Insufficient resources. And that's where the scarce resources comes in with, to combine with the make or buy decision. All right? And wishes to use a subcontractor to take on some of the work. So we want to know which work that could be subcontracted and how much is it going to cost the company. Because you don't want to subcontract something to an outside company and you are spending too much. All right, so related information to this job, we have average labor hours per job, budgeted number of jobs, excuse me. Then we have the variable cost and the subcontractor quote per job. Now, if you look at this data, what interests me here so much is the restriction. This 8,000 hours available. That is what makes it a scarce resource. So we are telling them that we cannot do anything above 8,000 hours. And so if all our requirements are more than 8,000 hours, we are going to find a way to subcontract some of these jobs to outsiders. So how do we go about this solution? First of all, you arrange the jobs in as a heading for each column. So we have the daily office cleaning job, the intensive job, and the minor repair jobs. Now, what is the cost of doing the job in-house? The cost of doing the job in-house is the cost of manufacturing that company. We are told in the question that can spend 600 naira, 1,080, and 560 respectively on the three kind of jobs listed here. Now, this is the cost of doing the job in-house. What about going to hire a subcontractor? Wow, the subcontractor's price is higher than the price of doing it indoors. And so, at a glance, someone might be tempted to say, why don't we take the job and do it in-house? But if you take the job and do it in-house, you will run out of available hours. And so you look at it now, the cost of doing it in-house is 600. The cost of doing it by a contractor is 200. What is the extra cost that you are prepared to pay? So if you're doing it by a contractor, you're going to spend an extra 200 naira to do the job. But because you have gave out the job to a contractor and you are willing to pay 200 naira, you are also going to save some hours for not doing the job anymore. So you're going to save 4 naira per hour for not doing the job in-house, for doing it via a contractor. So that's this 4 naira you're going to get. Okay, this is the 4 hours. I mean, not 4 naira, 4 hours. 4 hours. Okay, now 4 hours is what you are saving for doing the job by a contractor. Then the next thing is, how much is the extra cost per hour saved? How much cost is the extra cost per hour saved? So if you are saving 200 naira, which is something that, okay, this is the extra cost you are willing to spend, 200 naira per unit. And now this is the number of hours you have saved to take the burden off your hands. So yes, I'm paying 200 naira extra. I'm taking the burden off my hands. I won't be spending 4 hours anymore to do something of 200 naira task. Now, when you now divide 200 by 4, so yeah, it means that each time you do the job, each time outsiders do the job, for every 1 hour that you save, the extra cost is 50 naira. Now look at intensive cleaning. For each 1 hour you save, you are willing to pay 70 naira. Then you look at the minor repairs. For each 70 naira, for each 1 hour that you save, you are spending 140 hours. So if you were you are going to outsource those ones that you will spend the least amount of money. So it means that for the one that you are going to spend extra 50 naira for just 1 hour, that's the one you are going to give out first. Then the one of 70 naira in just 1 hour, that will be 10 seconds. And the third one, 140 naira for every 1 hour you save. You're willing to pay 140. Okay, you would like to do it yourself and see what is happening in that product line. So you will want to look at the ranking there. You see priority for outsourcing. You outsource the one you spend lower. Excuse me. Okay, so you want to give out the one you spend 50 naira, which is the least cost, and the one of 70 naira will only be given out if you have finished the one of 50 naira. You cannot give out the one of 140. So you see there is priority for outsourcing. Now the opposite will be the priority of doing it in-house. You want to do the one that will give you higher cost per hour saved. So that 140 is what you want to do first, followed by the one of 70 naira. Last one in-house is going to be 50. So you see there is an opposite effect. So, but you know, the company can do all these three jobs. Yes, but the company decided that they will have to take a subcontractor because it cannot do everything. It will just do two, but the third one will remain undone if they don't give it to an outside contractor. Okay, so let's see the next step that is going to be done, optimal plan. So after determining how you are going to rank them, the optimal plan is start with cleaning. Okay, so what are the total labor hours? For you to get this total labor hours of 1920, you need to know the number of budgeted jobs is 640. You can see it from the question, 640. Sorry, I'm trying to make a question. 640 minus 640. Okay, so that's the budgeted jobs. Then how did you get this total labor hours of 1920? That is it. Go to the average job hours per job. So minor repairs is 3. Minor repairs is 3. So we are trying to see 3 times 640. It's going to give me 1920. That is the total hours that is supposed to be used to do these 640 jobs. So when you find the contribution, you should be able to give this particular figure as a contribution. Then we have intensive cleaning. Intensive cleaning is the next one you rank. You look at the budgeted jobs is 400, and the total hours is going to be number 2 budgeted intensive planning is going to be 6 naira per unit. So 6 naira multiplied by 400 is going to give you 200, 2,400. So that's what is this. Then the last one is office cleaning. In office cleaning, that is where we have to restrict. Okay, now in office cleaning, your jobs is supposed to be 1,500, but you cannot take them because 4 hours times 1,500 will give you 6 hours. But look at it now. You are looking for 8 hours as a boundary. You already have 2 hours 400. You also have 1,920. You add these two together, you are getting about 4,320. So you just need something of 3,680 to complete this 8,000. So, but that is how it is done. So you cannot do the whole 1,500 jobs. It means you have to prorate to see which jobs can give you confidently 3,620. So what do? You divide 3,680 by the number of hours per job. Number of hours per job. I think it's number of hours per job is 4 naira. So when you divide that by 4 naira, you are going to this 3,680 divided by 4 naira giving you 920 jobs. It means that out of your 1,500 jobs, you can only take 920, along with all these other ones to give you one full thousand, to give you one full 1,500 jobs. Now, office cleaning will need to be supplied out because if you just decide to undertake 920 out of the 1,500, the remainder, which is 580, will now be done by a subcontractor. And the subcontractor gives us bill to be 464,000. So you add that with this other cost, you have a total cost of 1,806,400. So, but you see, this 1,500 less of hierarchy, or that's the product we are using, or this is cleaning jobs now. If we are taking 1,500 of the cleaning job as order from customer, we can only perform 920. That means we have to give out 580. That's the simple logic. We multiply 580 by the customer's purchase price, and that gives us 464,000. So if you add up all that we've done, both making it in-house or supply or getting it outside, we are getting a total cost of 1,806,400. Give me one moment, please. Okay, let us take a second question to see how this make or buy with scarce resources really works again. Now, a company makes 4 products, W, X, Y, and Z. All of them are made from the same machine, and the machine has a factory hours per year of 3,500 hours. Okay, so that means you cannot do more than 3,500 hours with that machine. The company is able to obtain any of these products in unlimited quantities from a subcontractor. It means that if anyone they cannot do any of these products, they can go and buy it from this subcontractor in unlimited quantity. Now, their customer would have ordered, and so for W, this is the demand, 4,000. For X is 6,000, Y is 3,000, and Z is 5,000. Now look at the selling price they are giving to these customers. The variable costs that they incur for themselves. Then look at the customer's purchase, the external purchase price rather. So should they want to outsource this product outside their company, this is what they are asked to pay. And look at the machine hour per unit. So for W, the number of hours is 0.25, a quarter of an hour. That's about 10 minutes. Then X is about 0.5 machine hours per unit. So it's about 30 minutes per unit. And 0.3 for W, 0.4 for Z. X, Y, Z, sorry. Required, which items should be produced in-house and which should be outsourced. Calculate the cost associated with the optimal plan. So what do? The variable cost for making each product is lower than the variable cost of purchasing each product externally. So because when we consider the variable make with the variable cost to buy, normally we would have said make everything because the variable cost to make is cheaper than the variable cost to buy. But because we have a constraint of machine hours, we cannot just make everything like our calculation will show. Now look at this again. Look at W, X, Y, and Z, the products. Look at the variable cost to make them in-house. And look at the external price to buy them outside. Can you see the difference? The external price are more costly than the variable cost to make it in-house. So some people will just say, oh, since the external cost is higher, why don't we make it inside? Yes, we can do it, but not all. So we need to look for a sensible way to apportion which one that is going to be of little priority to us and give it outside. Now, the next thing to do is look for the difference between the costs, external costs, and your own internal variable cost to you. It means for W, which is what I'm going to use as example, it means for W, you have extra costs of 30 naira if you are to give this. Since 80 minus 50 is 30. So if you decide to give this subcontractor, you're going to pay 30 naira extra from if you have to make it yourself. So now that we know our extra cost of outsourcing, we need to look at the material machine hours per unit in-house production. We are given 0.25, was given the question, 0.25, 0.5, 0.3. Source. Okay, now the extra cost per hour saved is that 30 naira by 0. It's going to give you 120,000, 120 naira rather, as machine cost of extra outsourcing per machine hour saved. So it means that for every 1 hour of machine time that you did not operate the machine to make that product yourself, you are willing to pay extra 30 naira. So that translates to 120 hours, 120 naira extra cost per 1 hour. So it means that in 1 hour, you are willing to spend 120. Another person is saying in 1 hour, I'm willing to spend 36 naira. Another is saying in 1 hour, I'm willing to spend 150. And the other one is 100. Okay. How do we rank? If you want to rank in order of outsourcing, you rank the smallest one first. And you go in ascending order until you rank the last one, which is the fourth one, I believe is Y. Y, you now rank it as number 40, because that is what you are paying the highest, followed by Z, and sorry, followed by W, which is 120, then by Z, which is 100. Now you now also rank for making it in-house. And I told you that for making it in-house, you have to look for the highest one and start doing it. Do not outsource the higher one, you outsource the lower cost per hour that you are going to incur. Then you now go to your production. In-house production, you start with Y, which you rank as number 1, followed by Z, which is number 2, W, which is number 2, and Z, which is the balance for it. Okay, so machine hours used in making Y is 900. So how did we get that 900? For Y, machine hours per unit is 0.3. Is this 0.3 that we have here? Now multiplied, so this is the machine hours, okay, multiplied by the number of job for Y. The number for job for Y is how many? Is 3,000 units, as you can see in this situation here, 3,000 units. So what do we do? 0.3 multiplied by 3,000 units will give you 900 machine hours for Y. Following the same pattern, we do that for W second, and you are going to get 1,000 hours. Mind you, we have 3,500 hours not to exceed. So we have already gotten 1,900. It means we are going to get the next 1,900, 1,600, What am I saying? Okay, let's take it this way. 900 hours has been used by Y. 900 hours used on 3,000 units. You go to the next one, 4,000 units for W. Multiplied by 0.25, you are going to get 1,000 hours. Okay, so 900 plus 1,000 is going to give you 1,009. And since you have a target of 3,005, it means that Z will not get everything it wants. Normally, Z wanted to do how many? Z wanted to do 5,000. But since you have a limiting factor here, if you say 5,000, you have to put 5,000 here and multiply it by 0.4. It's going to give you 2,000 hours. But the balance you need here is 1,600 hours. So what do? You simply say 1,600 divide by 0.4. That will give you 4,000 units that you are supposed to use. So this is the number of hours available, 1,600 for Z, and this is the number of hours for 1 unit. So when you divide 1,600 by 4, by 0.4, you are going to get your 4,000 instead of 5,000. Okay, so when you have your 4,000, you have severely limited that Z. So now when you are outsourcing, the remainder of the 1,000 that will make it 5,000, you are outsourcing Z. You are outsourcing the remainder of 1,000, and you are sourcing fully X. You are outsourcing X fully because internally you have exhausted your 3,500, and you have not done part of Z, and you have not done anything on X. So that's the one you are going to externally outsource. So I was talking about financial consideration before. So it's not only about the numbers. Yes, the numbers will tell you financially make it or diversify, divert it to outsource or make it in-house. But when you look at the non-financial consideration, you shall see that sometimes financials will not tell you decision to take. All right, so when relevant costs are used to make decisions, it is assumed that the decision should be based on financial consideration and whether the decision will add value or will add to profit, which is cash flow. Managers are also likely to think of non-financial issues as well. The non-financial issues in any decision will depend on the circumstances and will vary from one decision to another. Now, some of these non-financial considerations that are relevant to this make or buy would be when the work is outsourced, the entity that did the outsourcing will lose some control over the job that they outsource. It will now rely on external supplier to produce and supply the outsourced items. So when the supplier is dragging his feet and trying to supply late, it's going to have some serious impact, especially if you have deadlines to meet. It's possible that the outsource may not meet our quality standard. may use a lower quality to produce our job and be a loss to us. Then sometimes to the outsourcing company may fail to meet our delivery schedule on date. So we want to supply maybe 300 tomorrow and they have not finished the components that or the product that we need to supply. So they may not meet our delivery date. So we may need to call and cancel or push forward delivery dates again, and it's going to affect. So it's a whole chain process. Okay. Then there is a loss of flexibility when the, the product is outsourced. The decision to outsource work may have implication for employment within the entity, and it may be necessary to make some employees redundant because now something that you're supposed to be giving them to do, you have outsourced them outside. So ask them, do they have any job? No, some employees may not have job. Especially if they're doing, they're specialists in doing just that part that you outsource. So you might need to go through some of these uh, non-financial non-financials that will affect the relevant costs. Before we take this contract, one-off contract, please give me another 1 minute, please. Okay, now we have one-off contracts. One-off contract is a short-term decision by management. Okay, so we've talked about make or buy. We talked about using scarce resource. But management may want to carry out a one-off contract, something that is going to be done once and not intended to be repeated kind of job. So what do we do about one-off contracts? How do we make decisions as to whether extra revenue from the contract is higher than the relevant cost of doing the work, which includes opportunity cost. So let's see the incremental profit from the one-off contract is the revenue that will be obtained minus the revenue, the relevant cost. So we are going to look at the incremental profit. Incremental profit is the contract revenue minus the relevant cost. All right. One-off contract decisions might occur when the company has spare capacity. So if the company has spare capacity and wants to do the job, yes, one-off contract can come. But when they don't have spare capacity, when they don't have spare capacity, it means that something may have to be forgone Let's go to question 4 and see a special one-off contract decision. Contractor Limited is deciding whether or not to proceed with a one-off special contract for which it will receive a once-off payment of 200,000 naira. So that's the contract price. They're going to 200,000 naira. Now, details of the relevant cost are as follows. The contract requires 200 hours of labor at 600 naira per hour. Employees possessing the necessary skills are already employed by the contractor limited, but are currently idle due to downtime in business. Okay, let's be taking each step that we take, let's be analyzing them at the same time. Let me get to the solution so that we'll be analyzing at the same time. As we look at each statement, let's look at the way it's been handled here. Now, the relevant costs for what we just read here, that the special contract requires 200 hours. Now, if it needs 200 hours and they are going to pay them at 600 naira per hour, but the employees that will do the job are already in permanent employment, working for Contractor Limited. Contractor Limited is not going outside to go and outsource the job. They are doing it in-house. And the people who are doing it are already employed. They are paying them salary. And look at the question, they have idle time. Now, are you going to pay them again, different from their salary, when they are using their idle time to do this special contract? Of course not. That means the relevant cost for that is zero. As we can see here, the relevant cost is zero. Relevant cost is zero. Okay, so we look at the next one. Material X and Y will be used. Okay, so let's start with material X. 100 tons of material X will be needed, and sufficient material is in inventory, as the material is in common use by the company. Okay, so now they said 100 tons is what is required for the contract. You need to ask yourself the next question. Do we have it? If we don't have it, we are going to go and buy it. If we have it, we are going to use it. So we have it, and we have sufficient. So we don't need to go and buy again. But the question is it in common use by the company? Question say yes. So if it is in common use by the company, it means as you are using this, another person will want to use that component or product, and so you may need to go and buy. But how much will you buy? Will you buy it at the rate you bought it last time, or will you buy it at the current market price? So you see here that the inventory will be costing at 180 naira per ton, which is the current market price, and not the 150 naira that was used in buying it before now. Material Y, look at material Y. They said it's in inventory. That means it's already there. That means you don't need to go and buy extra one. As a result of previous over purchase, the original cost of material Y is 500,000. See, original cost is a past sunk cost. We don't use it in making decisions. We rather need a future cost to make a decision and not a past cost. So the original cost of material Y was 550,000 naira. It doesn't make any sense in terms of relevant cost because this is original cost, it's historical. But now they said it has no other use. That means this thing is not going to be used constantly. If you are to use them now in this contract, you may not need to replace. You may not need to replace because it has no other use. But right now, it is in your factory, your warehouse. Material Y is toxic. And if you are not using it for this contract, you may now need to remove it from the store and pay 24,000 naira to have it disposed. So 24 naira is how much you are going to pay for this toxic material to be disposed. So that means that is your relevant cost for material Y. That's 24,000 that you are going to dispose it. Is what is your relevant cost for Y. Then the contract will require the use of a storage unit for 3 months. Contractor is committed, so he's still committed to pay the rent for 1 year at a rental of 8,000 naira per month. Now that's a committed cost. You don't make any decision on it. The unit is not in use at the present. Fine. However, a neighboring business has approached Contractor Limited, offering to rent the unit for them for 11,000 naira per month. Now, how do you now charge this 3 months, this storage that will be used for the 3 months of the project? The 3 months of the project, if you are to use it, people have already committed to pay 8,000 naira. So you cannot charge this 8,000 naira to a storage unit, as storage for the unit, simply because somebody has committed 8,000 naira. But you are going to look at the relevant costs. That committed cost happened in the past, so it's not relevant. This new cost is going to be 11,000 naira. We can break it down into two. 8,000 naira for the rent of the store and additional 3,000 naira above the rent of the storage. And the next one, overhead are absorbed at 750. So overhead costs absorbed are not relevant. So the 750 is not that relevant. But now they have broken down the 750 consists of 500 naira for fixed costs or overhead, not relevant. And now the 250 naira for variable head is relevant. So this 250 here is going to be a relevant. So 250 for each labor hour. So total fixed overhead are not expected to increase as a result of the contract. So let's see what's happening here. So 200 hours multiplied by 250 naira, that gives you 550,000 naira. Now look at what the trading accountant did. A trading accountant has performed the following calculation, which shows that the contract will cost 359,000 to deliver. And so he said they should not accept the 200,000 naira. And it drew a description and relevant costs. Based on what we have looked at in relevant costs, some of these items are not in order. So let's look at how you, the chartered accountant, so to speak, will arrange it. So you see here, labor, we said labor is 0 because the people who are doing the job are having spare capacity in employment already. So, and here the accountant was saying 120. The accountant was saying 120 is what is the relevant cost. For you is saying 0. Material X, he is saying 15,000. But you, who should know better, has increased it to 18,000. Then material Y, the toxic material Y. And if you don't dispose it and use it in this contract, you have saved the company 24. It's no longer a cost now, it's a savings. So you take this 24,000. Now look at the storage. The storage, you take the contract, the new people who want to hire it for future price and not the committed price. So 3 months times 11,000 gives you 33,000. And of course, the overheads. The overheads, take only the variable part of the overhead and not with the fixed cost. So 200 naira multiplied by 250 per hour gives you 50,000 naira. Conclusion. After you see that total all the relevant costs, you're having 82,000 as against the 200,000 that was proposed by the customer. So when you've done all this, relevant, the decision is to accept the contract and not reject it, just like the trainee accountant was able to say. And you are going to make a profit of 118,000 incremental profit. So look at what have we learned today. We've been able to see relevant costs that is used to make or buy the product, and also outsourcing. And we now see how relevant costs affect the price contract. So any area you think that relevant cost is important, I would like you to let's discuss it in the WhatsApp group and see how we can tackle some questions related to relevant cost, make or buy, and price contracts. So once again, I will say thank you so much for coming to lecture this evening. Keep practicing what we told you. If you have any question, please feel free to ask. My number is showing on the screen now. You can take down my number and call me at any time, and I'll be glad to answer them. Right? Thank you so much and have a wonderful